son-in-law's father. So the lead's daughter is married to number three's son. Now he's Times richest, rich, and happily actually comes from a retail background. So he funded a company that became Tesco Metro. So he's had some kind of retail experience, but very, very traditional, sort of blue-blooded, old-fashioned kind of old money. And then the fourth was a customer who was a lawyer. Turns out, so he was married to an equity analyst in the city. That'll become clear why that's wrong later. But he'd always just been in and been open and said, I think it's a great idea, I love the shop. If you ever are looking to raise some money, let me know. So we did. So the deal was agreed reasonably quickly, so 750,000, so a little bit less money for 35% of the company. So the valuation was slightly worse, but that was due largely because they knew that the institutional fund had gone away. There was no due diligence. So whereas we had this incredibly structured, and you would expect a VC to go through a pretty rigorous diligence process, there was none from the angels. They basically read the business plan and said, okay, that's fine, let's do it. I'm sure they called people and sort of got a bit of feeling for how our concept or how the shots were going down, but there was nothing formal. Then the customers, number four, pulled out because he thought the EBITDA multiple was too high. Now, EBITDA is earnings before interest, tax, depreciation, and amortization. Surprise, surprise, this came from his wife, who was the equity analyst. Now, we were an early stage business where it was marginally EBITDA profitable, but not in any meaningful sense. And in the same way as any early stage growth business relies on future value rather than current value, we looked expensive. I mean, our EBITDA multiple was probably 30 or something, which was seen as being far too much. I was a bit frustrated with that. I thought it was pretty unfair because they knew that before they started, so it wasn't there was no new information there. So this was very annoying because suddenly our nice consortium of four people, one fell over. So it almost collapsed. The lead said, well, screw it, nothing's changed. We're just doing the same deal on for a little bit less money. Unfortunately, three took advantage. So he saw that the deal would only work if he continued to stay in. And so he said, fine, I'll only do it, but I want a 15%, 20% price cut in order to get the deal to happen. No rationale for it, not because of any reason, just because he could. But it's probably, I mean, do you blame him in that situation? I don't know, it's probably a relatively canny thing to do. It was quite irritating to be on the receiving end of. So we had no other option, so we agreed £630,000 for 37%. And I suppose the other option was us not to raise any money. We weren't burning any cash. We could have just stayed where we were, but I couldn't. I just would have. We really would be starting again from scratch and having to probably retrench for a year and then go back out again. And it just seemed to me, I want to make some money from this business as well as enjoy it. And it just seemed to me it would take too long, basically, if we had to restart the whole process again. So, although we got shafted a little bit on our price structure, I think we did reasonably well on the terms that we agreed, largely because they didn't do any diligence, and therefore their legal advice was similarly lacking in any structure. So we gave them a seat on the board, which I think is a good thing. So there's myself, my co-founder, and them on the board. We agreed that we'd look for a chairman, which again we're still actually looking for. Still haven't found a chairman who we think is appropriate. Information rights, so they get information on trading for each board meeting, as you'd expect. And a forced sale. Now this is one of the this is the only positive covenant that they negotiated, and that's basically saying that if we haven't, what they asked for was if we haven't sold the business within 5 years of investment, they could force us to sell our shares because myself and my co-founder were still in the majority of the business. That's relatively commonly asked for, but there's lots of flavours of it. So If it had been that they wanted power of attorney over our shares to literally drag them over to the buyer, I would have been quite nervous. What we actually negotiated to was a position where we agreed that the board would consider whether it would be appropriate to hire an advisor to consider selling the business. Yeah. So there was actually nothing giving up. The other reality with this is actually, if they wanted to sell it and the management team didn't want to sell it, it's not going to get sold. So if ultimately it had come to it and they really did want the forced sale, we would have given it to them. And what were they ever going to do? You can't sell a business if the management doesn't want to go it, unless it's a very big, substantial company. So yeah.
Can I ask what the price mechanism was for the sale?
Well, it was at market value. So we go out, we hire an advisor, and they would find a solution. We didn't agree that in the end, so we just agreed that we would get the advisor in if it came to it. So blocking rights. If you think, so there's kind of three voting groups, myself, my co-founder, and as it turned out, any two of the three investors. Now, of the three investors that are there, basically one of them is quite difficult. So this old money guy is a little bit hard to deal with. He kind of is not, some days he comes in and he's just full of the joy of spring, and other times he's just quite miserable and sometimes slightly illogical as well. We're a bit concerned about him. How we got around it was we in effect broke the votes into three different groups. So myself, so I own 31%, Dawn owns 31%, and the investors own the remaining, where it is 38%. The investors would speak as two out of the three. So if they wanted to vote for something, you have to get two of them to agree to it. No group can block anything. So in other words, if the company was to be sold, none of those three people could prevent it, as long as the other two wanted to do it. Now, in this case, that means including me. So under company law, in reality, I could block, if there was no investor agreement, I could block the sale, or I could block not just selling the business, it could be anything. It could be acquiring another business, it could be winding us up, it could be going into a new line of business, it could be many things. Normally, I would be able to block that. So I was giving up the right to block, but gaining some confidence that it was going to be very hard to see how the other two people would be voting for something that was wrong. So probably, if I thought something was a bad idea, but the other two people thought it was a good idea, it was probably a good idea and absolutely wrong. So if ultimately I care more about the value of my equity than about my job, which I do, then I'm kind of happy to give up that control in order to have a company situation which should be scalable and which allows us to actually do stuff. There was lots of problems in terms of raising a new investment round. You can come up with lots of problems if people have different outlooks on life and want different things. And suddenly you can have quite a small shareholder actually blocking the entire investment. In this structure, you didn't think that, we'll see, but you didn't think that was going to be a problem. Three, so the slightly difficult investor realised his lack of control 2 days after signing. The irony is that actually Dawn and I could sell the business tomorrow for less than the amount of money that they put into it. Now, any professional investor wouldn't have allowed that structure to exist. They wouldn't allow themselves to be dragged out of the sale we could sell it for the value of cash plus a bit for the assets, and we would have made some money. The reality is that we're not going to do that. However, it does show you that actually that level of professionalism on their side wasn't really there. And so, of course, he realised 2 days afterwards and asked if he could reopen the documents. So, the answer to that is relatively straightforward. No. It's actually worked quite well in general. 3 is difficult to deal with, and it's continued to be difficult. But he doesn't have any rights. He himself can't do anything. So even in order to have a vote at the board, he has to persuade one of his other co-investors in order to come along with him.